Yeah, so it gets recorded to the cloud,
Yeah.
and then they.
But you do your audio locally, do you? You don't get you do your record your audio there, and then my audio comes off the Zoom. Is that right?
I think it just gets all recorded from on Zoom off the cloud. Yeah.
Oh, right. Nice. Very good.
Yeah. So I'll do the show notes afterwards, and then I will. If I need anything from you, I'll just let you know, and it'll go live on the 1st when we're at Belfry. Okay.
Great. Yeah. Sounds good.
Hi, it's Mark, and really excited to be welcoming my next guest, Mo. How you doing, Mo?
Hello, Mark. Yeah, very good. Thank you.
So Mo is on the Property Entrepreneur Board for the 2nd time. So you took a year out with your new baby?
Yeah, had a year off last year when we had our son, and then back raring to go this year. So
excellent. So for anybody that doesn't know you, would you like to give a brief introduction?
Yes. So I'm Mo. I am now 36, having just had my birthday a couple of days ago, and full-time in property since 2016. We've got a couple of businesses. We've got 𝗁𝗵𝗶𝘀𝗁, which looks at sourcing, refurbishment, and management of HMOs down in Plymouth, in Devon, in Southwest. And then we've got a development company, which is 𝗂𝗶𝗀 Group, and we specialise in converting heritage and listed buildings, mostly into apartments to sell. And again, that's down in Devon, between sort of Plymouth, Torquay, and Exeter. Our main projects have been and are at the moment. So that's the two sort of main areas of focus.
You're actually based in London, are you?
Yeah, I live in North London. So the story is, myself and James, one of my business partners, met in halls actually at Plymouth University. So down there, we got put into the same halls and became friends then. And then he's sort of really into construction, got a construction background, and went and did that after uni. And I was sort of doing business and economics and accounting, and we sort of came together and were like, we can do this property lark. So in our we did like an industrial placement year between the 2nd and 3rd years of uni. So we both had an income and managed somehow to get a mortgage for a property, bought an HMO, although we didn't know that's what it was called at the time, in 2010 in Plymouth, and did some work on it over the summer, and then lived in it in our final year. And that's how it all started. Lived in our final year, rented a couple of rooms out to friends, which sort of covered the mortgage and the bills. And then excuse me, we kept that property for a couple of years while we went off and did our graduate sort of placement years and graduate training programs and stuff. James worked in construction, I worked for Lloyds Bank, and then bought a couple more properties. And then by 2015, James quit his job, and then 2016 I quit mine to jump in full time. But that's why we started down there. And then through the PIN network, we met our business partners in 𝗂𝗶𝗀. So James and I are in Moorview, and then we joined forces with our business partners for 𝗂𝗶𝗀, who have got sort of, one of them's been an architect for 30 years, one of them's a building surveyor, one of them's got a sort of interior design background, and so we sort of joined forces with them to create 𝗂𝗶𝗀.
That's good.
And that's why it's all based down there. But yeah, they all live either in Plymouth or in 𝗂𝗶𝗀, and I'm up in London. But a lot of my role is around investor relations, and I've had a lot of investment meetings in London, and it's just a good place to be if I need to travel sort of north or travel anywhere to meet anyone, or it's just good being based in London. So it's worked quite well for my role.
That's good. It's interesting then how you met your business partners then, PIN meeting. So it is good to get out and network with people.
Absolutely. So one of our business partners, Phil, was the host of the PIN in Exeter.
Okay.
And we sort of basically, as soon as we started doing property seriously, we were PIN helpers. And I think that's a really probably good top tip when you get started, is you just get out and, I mean, you don't get paid anything anyway. It's just sort of voluntary, but the point is you get exposure, you get to speak to everyone there. You start, you get there before everyone else, you leave after everyone else. You get to speak to everyone, find out who's got deals, who's got money, who's got experience. and it gives you sort of a platform and credibility. So and in fact, I don't know if they still do it, but it used to be that the 𝗵𝗶𝗀𝗶𝘀 got the first session to, like, you know, when you all stand up and say what you're there for. It used to be like they let the 𝗵𝗶𝗀𝗶𝗀𝗀 do it first, and then they went to everyone else. So you were always like the first person to stand up and speak about what you were doing and what you wanted and what you could offer other people. So yeah, it's definitely a good network to meet people in. Yeah, and actually another thing on that, when we first started working together, Phil actually offered to do some architecture work, because he's an architect. He offered to do some drawing work and a bit of planning stuff for us, and then we were like, okay, yeah, amazing, thank you, how much can we pay you? And I still got the email, actually. He emailed back saying, oh, don't worry, like, we'll just do this on the basis of like building a relationship and, you know, something for the future.
Right.
So he didn't charge us anything for that. And then that one, you know, bit of work that was probably, I don't know, a few grand's worth of work has now sort of escalated into a, you know, a fairly sizable development business, and we've done quite a few projects together. So yeah, I suppose that's another thing to sort of think about in terms of like building relationships and networking.
Paying it forward.
Yeah,
that's good. How did the first conversation get going then, as far as working together? How did that, because I think people might be listening, maybe on their own. Property can be lonely, and it's kind of like how to work with other people. So how did that actually come together?
Yeah, so we needed, Phil had a skill. I mean, we already had a relationship, like we knew each other. So that was, I suppose, the key thing. It's sort of like know, like, trust, that kind of model. We already knew each other because we were both in the PIN network and we'd met a few times and all that kind of stuff. And then you just get talking around like, oh, we're doing this project and, you know, we need some support with some drawing work and advice on stuff. And then he then said, okay, well, you know, I can help you out with that stuff. And then, yeah, so it's just talking really, and just finding out. I suppose the key thing is, what do you need and what can you offer other people? I think that's the key thing. And I think the one of the things that works with 𝗘𝗶𝗀𝗶𝘀 is that we all need something, because we don't have all the skills we need to be able to run a development business individually. But we also offer something different from what the other people have. So for example, Phil's expertise is architecture. I do sort of investor relations and sales and marketing. James is a construction manager, so he does a lot of the sort of project management and project delivery and ops and stuff. And then Kyle he's a building surveyor, but he's basically the finance director, does all the finance bits. And then Zai was sort of more involved with interior design and stuff like that. So I suppose, what's the phrase? The sum of the parts are more than the individual. I don't know what the phrase is, but you know, like we all come together. And I think the key thing when you're starting out is, what can you offer other people? Like when you're starting out, there's loads of things you need. Like you need experience, you need money, you might have time. What can you offer other people that can help fill their gaps? And I think that's why we started working together originally.
That's good. And then as far as Property Entrepreneur, was it about 2018 that you joined?
Yeah, so Phil actually was, I think he did it the year or 2 years prior to that. And it was quite funny, because he always used to come to our board meetings and tell a story about, you know, about the race car analogy. Like you can't drive the Formula 1 car all year at like full speed and stuff like that. And we always used to take the mick out of him. And it used to be a bit of a running joke of like how long into the board meeting until Phil mentioned something about, you know, the business being like a race car and you have to rest it at certain times in the year. So that became a bit of a running joke. And then when we started, myself, James and Kyle actually then started doing Property Entrepreneur, we were like, so this is what he was talking about. Like we we felt a bit bad that we'd taken the mick out of him for all that time, but it made perfect sense when we got started. So yeah, about I think it was 2018, 2019, we started, all three of us started going along. To PE,
And then you joined the board couple of years ago.
Yeah, so joined the board in 2020, which was great. I loved it, and then had a great year, and then just decided to just take a year out and just go back to doing the advanced program last year, when we had our son, and then just restarted a couple of months ago. So
And for those into wealth dynamics, what's your profile?
So I'm a dynamo, I'm a creator. I'm more like creator star, so like I'm like top right a bit more, but I'm quite rounded. So I've got a sort of my profile is fairly rounded with
Yeah.
a little bit of sort of the biggest bit is towards creator star. So, and then James is similar to me, but his slight preference is more like creator mechanic, so like top left. And then two of the other directors in 𝗘𝗶𝗀𝗃 are creators. So Phil and Zy are both creators, which makes sense because Phil's an architect and Zy, has got interior design background and skills. So that sort of makes sense. So we've then got Kyle, who's our resident lord, who helps trying to balance us out. But and then pretty much, well, a lot of the team that we've recruited and that we've got now fill in other gaps in the business. So we've got we've got a 𝗬𝗵𝗶𝘀𝗁 who's one of our who's our development manager. So he sort of, from an ops point of view, just keeps everything on track and runs the projects day to day. So, and I think that's the key thing. You either have, in terms of skills and I suppose profile as well in wealth dynamics, you either need to have a mix of that in your board and your directors, or within the team, or both. So you've sort of you've got different skill sets. But it's definitely been a challenge for us, and I think having 4 creators is versus one lord is always a bit of a challenge, which is probably why we've done, in the past we've done service accommodation and we've done HMOs, which we still do, development and stuff like that. So we've honed it in a bit more over the last few years and stopped doing stuff like service accommodation, things like that. But
so the main strategy there for 𝗘𝗶𝗃, what is that then?
So it's converting heritage and listed buildings into apartments for sale, basically. We've done a couple of projects where we've done big HMOs. So we've done a 30-bed HMO and we've done a 32-bed HMO. Nice. Projects that we've sort of refinanced and held on to, just to build the HMO portfolio. But predominantly it's selling the units, because when you get through the development and you've got the units at the end of it, you have to put them on for a premium price, because projects generally overrun and cost you more than they think they're going to cost you, and you've got investors on board. So we've looked at it before in terms of just refinancing those and holding on to them, but actually the yield on the flats aren't always fantastic, depending on where it is, because we generally try and do projects in sort of high value areas to make the value stack at the end, and that generally suppresses the yield, and you don't get as much yield there. So we usually sell all the units after development.
And how do you typically source these projects?
So we've done everything, basically. We've done so going through the CQC register to see where there's because some of the projects that we've done are care homes that have closed down because they've had bad CQC ratings. Going through Ofsted reports and trying to find where we can potentially write to schools, write letters to care homes that are closing. And actually, the one we're going to talk about, we actually wrote them a letter. I can't remember where it came through, but it came through one of the sort of direct letter channels that we were using. It could have been CQC actually, because I think they had a bad CQC rating, and actually nothing came of that. But then a little while later, we then actually got the lead through Savills, and it was a relationship that an existing relationship we had with Savills. To be completely honest, for the size of the units, for the size of the stuff that we buy, and the sort of heritage listed building element of it, those things, most of them have just come through agents. It's a trickier one to do direct to vendor. Usually the size of these buildings, they have a board, or they've gone into administration, and then you've got various administrators or liquidators you've got to deal with, or it's probate and you've got to deal with an estate. They're not like your typical, you might write a letter to someone with a house and they're like a motivated seller, and then they just want to sell it. This stuff is a bit more sort of sophisticated in terms of how the decision making is, or how the decisions are made. So we didn't actually have loads of success with letters. We had a couple of leads through, but usually it fell over when you got to the point of who's the main decision maker, and you might have one or two of the people on board, but other people are actually. The other thing with direct to vendor letters is again, for stuff like this, they typically have to like prove best value, and so it's not just one person making a decision as to like, oh, I'm happy to sell it at this because I need the money. It's like they're then like, oh, well, I need to get a RICS valuation, and I need to put it to 3 local agents to give me a valuation, and it needs to be on the market for 90 days before I can sell it to you. You know, those kind of stipulations. So it's a bit trickier to do direct to vendor. I'm sure it does happen, but for us, it was just build good relationships with the agents. The agent we bought this off, we actually then bought our next deal off, which is a private school, a closed down private school in Exeter that had gone into administration sort of just at the beginning of COVID, and had some bad Ofsted reports prior to that. And again, it was just through the same agent, and just those relationships really, just proving that you're credible. We'd done this deal. The agent knew who we were, knew we were good for the money, knew we had investors, etc. Knew we weren't going to mess them around. So great. That's the key thing, really. Yeah.
And when you're stacking deals, how do you go about that?
So generally the process is I'll do the sort of first pass, go out and have a look at it, and if it's worthwhile going to have a look at, do sort of back of a fag packet calculations around like how big is it, how, you know, how many units could we get in there, those kind of things. Working a little bit with Phil in terms of send him the plans, and he sort of does a block plan of like, you know, just shades and area ins, like that's a 2-bed flat, that's another 2-bed flat, you could do an extension here, those kind of things. Very, very high level, quick and dirty, as some people call it. And then if it passes that, it will then go on to a detailed appraisal, which is what Kyle does, which is you know, very detailed spreadsheet with all of our previous costings of how much things have cost us, and loads of formulas in, and then, you know, the risks and risks log. So like what are the risks in the project and things we need to close out before we sort of exchange on it. And I think that process works really well. I think if you have the detailed stuff up front, you either end up saying no to a lot of things early on because you haven't had the sort of creativity and optimism at the beginning of like, come on, we can do something here. That's not working. What about this? Those kind of things. Yeah. You either do that or you end up spending a lot of time analyzing stuff that wouldn't have even got through like a quick and dirty sort of back of a fag packet calculation. So you have to do that sort of high level first, and then any that pass that you can do a detailed and spend, because once you're into a detailed appraisal, it's probably like half a day of work, you know, all the back and forth, trying to get the numbers in there, having meetings on it, half a day to a day of work. So you can't just do that on every deal all the time. Okay, that's our process.
How do you then structure deals? So you mentioned you've got investors. So what do you do per deal? Is it setting up an SPV, and then how's that actually work?
So we'll have an SPV. The SPV will be 50% owned by our, like, we've got 2 holding companies. We've got a trading holding company and a holding company, if that makes sense. So all of our HMOs we hold on to are in the holding side, because the tax treatment's different for the two. On the trading side, we've got a holding company for tradings. A holding company for trading that will own 50% of the shares of the SPV, and the other 50% of the shares will be owned by the investors that invest. And essentially, the investors put in the equity for the project, and will then, as a loan, they'll then get the loan back, and there'll be a 50-50 profit share at the end. Over the last few years, we've introduced preferential interest rates. So essentially, when you get the profit at the end of the project, the first slice that comes out is a sort of an amount of interest that's calculated on the loan. And what that does is that protects investors from projects that take longer and, you know, go on for longer, because as the longer the project goes on, the more that interest amount accrues. And then actually the smaller the pie is when you then come to do the 50-50. So it's a really good, you know, it's been very popular with our investors, that mechanism. And also it's a good, you know, incentive for us to try and get the projects completed as quickly as possible, because then, you know, the pie is bigger in terms of the 50-50. So that slice comes out first, and then we then split the rest 50-50. So that the investors know that as long as there is a profit on the project, they're going to get at least the interest rate on their loan. So it sort of de-risks a lot for them.
Yeah. So if there's money left in the deal, is the interest rate lowered to like more of a commercial rate? How does that actually work?
Well, this is why we sell everything that we've got investors in on, because it's just a lot cleaner. So we haven't got any we haven't got any projects that were going to be development projects that we sell at the end that we've then flipped into holding.
Okay.
We've sold everything that we've got. Otherwise, yeah, you're right. It would be, you'd have to lower the interest rate down to something more commercial. But no, we've always just sold everything that we've done under this structure.
Okay.
Yeah. Otherwise, it's too confusing. The investors are investing for, you know, the returns, the risk and returns of a development project. So, you know, they're expecting the money out at the end.
And typically, what interest rates would the investor
We've
get?
done some of them have been 7.5, some of them have been 10. It's sort of deal dependent. Like, what are the risks on the deal? Is it like a surefire planning? You know, like slam dunk on the planning? Is there a bit more risk in the planning? So we've done.
As well.
Yeah, exactly. Well, no, that actually isn't. No, all of the investors get the same, like regardless of how much they've put in terms of the interest rate. It's more about the deal specifics and whether the deal is, you know, if the deal is slightly more risky in terms of it's 50-50 on the planning, or the planning might be for 10 units or it might be for 15 or whatever. Then the preferential rate can be a bit higher, but yeah, it varies on that.
Okay, so do you want to introduce the deal we're going to discuss?
Yes, yeah. So the one we're going to go through is in 𝗵𝗊𝗀𝗃. So this one was a former. It's called 𝗁𝗵𝗶𝗀 Hall. So when we bought it, it's called 𝗁𝗵𝗃 on the market through 𝗂𝗶𝗀𝗃. We actually entered into a sealed bids tender process for by the time we actually got to to buying it. So there were other people interested, and we actually then had to submit like sort of the sealed bid on it. It was formerly a sort of like a secure NHS facility for young people sort of with mental health issues. But it had just been over the years, it just the standard of care just got worse and worse, and the CQC report sort of reflected that. So then it went into administration, and then it was being and then we just dealt with via Savills. We then dealt with the administrator. I mean, it's an amazing property. It's got sea views on it. It's got huge grounds. There's like loads of trees and big fields and stuff on it. So it was an amazing building. In the end, we got it at for 800,000. So it was a big main building, and then an annex, and then there was like a link building between the main building and the annex. It was like a later addition annex. So then our plan was to then just knock the sort of the link building down and then have two separate units. So then we could put flats in the main building and then houses in the annex.
I think for those interested in numbers, you sent over some details. So the main house, 762 square meters, and then the annex 324, so just over 1,000 square meters, and 11-acre site. So
yeah,
really,
it's big,
really nice.
Yeah, big site. Yeah, really nice big site. So yeah, it's a lovely building. So yeah.
So the plan was to convert it into apartment. So you kind of like worked out how many you were going to get. Were they a mix of 2s and 1s, or were they all 2s?
So we got 1, 2, and 3 beds. Yeah, so there's 1 3-bed in there. 2, mostly 2s, and then I think 1 or 2 1-beds. Yeah, so again, working with Phil, who's one of the directors of 𝗂𝗶𝗀𝗃 and is also an architect, got his own practice. So yeah, we sort of worked out what the plan could be, and so we've got 4 units accessed off the main entrance. So we've got like, usually the developments are done around like stair cores. So like how many can you have coming off each stair? So the main entrance and the main stairs, you've got 2 units there, and then you've got 1, 2, 3, 4. Yeah. Sorry, let me just 1, 2. Yeah, 4 there, and then you've got 3 off the second stair core, and then you've got 1 that's actually got its own entrance. So yeah, sorry, I confused myself there. So you got 4 through the main entrance. You got 3 units through a second entrance, which is sort of like round the back, and then you got 1 that's actually got its own private entrance. So it's really good. one, two, three of them have got private gardens with sea views.
Oh, nice.
You've then got one that's got a private garden that's just sort of around the back without sea views, and then that's the sort of for the ground floor. And then the first floor, you got sea views out of a couple of the units at the front. Yeah, and then in the annex, we then put four houses in there, so they're three bed houses in there. We did
nice.
some extension works on the annex, and yeah, just created four units there. So.
And how did you actually fund all this then? So did you have like different stages of funding? How did that
Yeah,
go?
so we started with Lend Invest. So before we, I don't know if it's the case now, but previously we used 𝗬𝗶𝘀𝗃 basically for everything normally.
Yeah.
At the time we did this, 𝗬𝗶𝘀𝗃 didn't do a no planning product. So if you didn't have planning, basically they couldn't fund the deal. So they weren't doing like bridging. I'm not sure if that's changed now. We've always done our like development. Once we've got planning, we've always done our development sort of loans with them. So we used Lend Invest, and then we used our investor funds to obviously buy it as well. That was the bridge to get the planning, and then once you got the planning, you can then go on to the 𝗬𝗶𝘀𝗃. So you refinance the land, and then also get the development tranches through 𝗬𝗶𝘀𝗃 as well.
So anybody looking at some of the deals, loan to values on the initial kind of like without planning?
I think initially it's like 60 to 65% loan to value. Obviously you haven't got planning, there's a bit more risk in it. And you're looking at, 9 to 10% per annum, so like 0.8-ish % per month for bridging, and then various fees depending on sort of who you go with and how it's set up. And then 𝗬𝗶𝘀𝗃 fees are similar, but you can usually borrow up to 70% of the land value and then up to 100% of the build cost. There are some exclusions which you speak to them specifically about, but where possible they'll fund as much of the works as possible.
Okay, yeah. So this particular project, how long did that take?
So the actual build, so I've got the dates here actually. So we exchanged in the end, we exchanged in June 2020 and completed in August. And we'd actually managed to get the planning in between, sort of in the run up to, we submitted the planning in July. So we exchanged in June, we submitted the planning in July, and then we completed in August, because that just gets sort of ahead of the whole process. Went to committee for the planning approval in November, and then we started on. Sorry, we got the planning in November. Started on site in May 2021, and it ended up being July and August, because there were two separate phases for the practical completion, 2022. So in the end, the actual construction work took just over a year for the main building, and about May, June, July, August, almost a year and a half for the final phase. And the main cause was, it was supposed to be like 9-10 months program, but it was just dragged out because of COVID staff shortages and other sort of staff shortages. It's a little bit of materials availability, but not as much as the staff side. That was the real, that seemed to be the hardest thing to get hold of.
What would you say was the main challenges then of the, I think you alluded to a couple then, but
so the two main ones for this, so we had some challenges with the next part of the deal, but the main challenges for this were the labor shortages, predominantly due to COVID. It was, I think, other reasons as well, probably sort of a bit of Brexit and a bit of mostly due to COVID though. And then also sewage, in terms of sewage treatment. There was an existing sewage treatment facility there, but it wasn't suitable for what we were doing, because it was for the previous use of the building. So there, at one point we were looking at potentially having to put a pumping station in to get up to the main sewer, and that would have been like best part of 200k basically to do that, and that just wouldn't have been viable for the project. So there's a whole load of sequential tests that you can do. You work with the Environment Agency, and actually we had some fairly lengthy delays in terms of the Environment Agency discussions as well. But you have to get a license and approval from them to actually use a sewage treatment plant and put one in, rather than having to go to a pumping station. So anyway, there's sequential tests you can do, viability that you can prove, just basically to say, look, the deal wouldn't work at 200k for a pumping station. So in the end, we ended up with putting in on a sewage treatment plant there, like a small sewage treatment 𝗘𝗶𝘀 unit, which is a good outcome. And then you're looking at like, I think it was like 30-40k rather than 200.
Big difference, yeah.
Huge, yeah. And yeah, that was it for those. I mean, there was loads of other things, but like there is with all development, but those were probably the biggest ones.
You also mentioned about the reports that you had to do.
Yeah, well, that was for the land. So for the second phase. So when we were getting planning for the second phase, which we're going to talk about, there were certain ecology survey windows that we had to work within, and because we didn't get all of the reports we needed within the initial window, when we came to do the second part of the planning, which was submitted in December, they wouldn't validate the planning until all of the surveys were done, and actually the next survey wasn't until June. So it was 3 of the 7 bat activity surveys, dormouse survey, and breeding birds. So those were the 3 things that they needed doing within a certain window, and unfortunately we'd missed it on some of them. So if we'd done it again, we would have. I think that's one of the main things. You need to get programmed in at the right time.
Yeah. To check what reports that you're likely to need, and then look at those when you're coming up to negotiation completions.
Yeah, absolutely. Yeah.
Okay, that's interesting.
So we lost. Well, it was December to July, so we lost 7 months on the second phase, just because they wouldn't validate the planning without the reports, even though the ecology consultant was like, we can write letters and we can say that there's nothing, we've got a lot of the information already and we're not expecting to find anything else. But yeah, they wouldn't validate. And it wasn't like they would validate the planning and give you a decision, but like subject to XYZ, they just wouldn't validate the planning at all. Right. So if they don't validate the planning, then the timer doesn't start in terms of the amount of time they have to respond in. So
okay. So we were talking about, you've developed the main house, you developed the annex, and then you've got 12 apartments. Yeah. And then
we've got 8 apartments and 4 houses. Yeah.
Oh yeah, sorry, 8 and 4. Yeah. And then there's also then additional bonus to this.
Yeah, there is. So as we were going through this project, and it wasn't something that we thought of initially when we bought it, although we didn't know there was like potential to do this. That we saw there was a lot of land, as you mentioned, there's a few acres of land with the property. So we were like, right, is there something that we can do on that? We knew that it was fairly, well, at the time, fairly low probability that we get any planning on it. So we sort of excluded it from all of our numbers. We said to the investors that this is a maybe, but don't get your hopes up. Like the deal had to stack just purely based on its own its own numbers for the conversion of the buildings that were there. So initially we estimated the GDV would be between 3.7 and 4.9, and the profit would be, anywhere between 0 if it all went wrong, up to sort of 1.5 million. So, but that was without any of this new sort of this planning for the land nearby. In the end, the GDV was 4.65, so it was within the range, and the net profit was about 670. So again, it was like both of them were within the range, but obviously the profit had come down a little bit because of the just the time delays and getting everything done. You got time, which obviously costs money when you've got a development finance facility that's sort of 10% a year, whatever. It all adds up. But then we had this extra element with the land. So what we did is, before we drew down the development loan with Crowd Property, and actually before we refinanced it at all, we actually split the title and split the land off into a separate SPV. Okay. The reason we did that is because 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 the development lender would take a charge over all of the land and everything associated with it. If we hadn't split the land off, but then we'd got planning and wanted to sell it, all of the sale proceeds would have gone straight back to Crowd Property to repay the loan, which actually the loan wasn't for the land, it was for the conversion of the main buildings. So that's a top tip if you're doing that actually having it on a separate title and owned in a separate SPV meant that even though we haven't, we have actually now paid Crowd Property back because we refinanced the building while we're selling the final units, but none of that money, if we sell the land, none of it will go back to the to the lender. So that's a really important point as well. So yeah, and then so we put in planning. We went through various iterations of planning, and we ended up with nine detached houses. Went in for planning on. Well, we first submitted it actually Christmas Eve 2021. The council wouldn't validate it because of the ecology surveys, as I've said. The window didn't open again until June, so we got those done in June, and the planning was validated in July this year, and then in October this year, we got approval for 9 houses. And the main reason, the report was sort of like, this is an area where the policy states we shouldn't allow houses to be built, and et cetera, but the main driver was because they've got sort of an insufficient there's a lack of 5-year housing supply, so all sort of local authorities have to be able to evidence their 5-year housing supply, and I think they've got 𝗘𝗶𝘀𝗶𝘀 like 2 to 2.5 years, so they're just falling short of like how many houses they need to build or have converted or created or whatever. So that was the main driver for getting it approved, because they know that if they refuse the application, then we go to appeal. The inspectorate will look at the 5-year housing supply as part of their decision making of whether they overturn it. So that was good for us. So Watcombe Park hopefully will get to sort of 800-900k net profit on it, which will be amazing if we can sell it. So
excellent. Yeah. Excellent.
So that will sort of bring the combined profit for both deals above where the sort of original estimates were, even above the sort of top end estimate from the original. But obviously we had a bit of a impact on the timing of the first part of the project. So that's sort of making up for a bit of that as well.
So the total profit is likely to be, what would you think?
Well, I mean, hopefully north of 1.5, 1.6.
Excellent.
All in. Yeah.
Excellent. Yeah. Congratulations.
Yeah. Thank you. No, it's good. It's a fantastic project. We're very, very happy with it. Obviously the profit then goes to 50-50 share with the investors get their accrued interest, then it's 50-50 and stuff like that. So but yeah, it's great. We're very, very happy with it. So
great. Yeah. So as far as top 3 tips, what would you say?
Yeah, so I would say definitely buy deals based on, so stuff like this where you've got some land on the side. I think just make sure the deal stacks on the sort of thing that you're more confident on, in terms of like, right, getting planning on a converted, because the planning for the conversion was not a dead cert, but it was quite likely that this was a former commercial building that had gone into administration, not fit for purpose anymore. Antisocial behaviour has gone on there. All of these other things, like the likelihood of getting something like that into residential from planning point of view is quite high. So we were quite certain on that. We knew we'd get something. Maybe we get 7 units, maybe we get 9, maybe we get 4 houses, maybe we get 2 houses, but within a range, we knew we'd get the planning. And then but then the bonus on top is the land was amazing, but we wouldn't have bought it if we were reliant on the land to make the deal stack. So that's the first thing. As I've talked about, the ecology surveys was a massive one. So just make sure you understand when the ecology windows are and which surveys you might need. Leverage experts. So, the success of this has been down to, partly down to specifically planning consultants, environmental consultants, architects, all those kind of things. So that's been a big part of it. So definitely leverage those people. And then I think finally, just under promise, over deliver. It's something we will always try and do, but we didn't have any of this extra land in any of our sort of financial appraisals. So when we got the planning through, it was like, an actual uplift. It wasn't like we had already banked it. It was like, actually, that's amazing. So yeah.
Fantastic. Anybody who's looking to contact you, what is the best, what kind of interest would you say for people to contact you, and how would they contact you?
So I think there's two routes. So if anyone wants to know more about the project or wants to know about investing with KHP, give me an email on murat@khpgroup.co.uk. So it's murat@khpgroup, all one word, .co.uk.
Okay.
Also check out the property vlog on YouTube. So it's the property and then vlog, VLOG. So on there, I've got a load of videos of past projects that we've done and current projects, sort of before, during and after, loads of bits on there. So check that out on YouTube. And if you want to know more about investing in HMOs in Plymouth, or talk about HMOs or anything like that, drop me an email on murat@𝗁𝗶𝘃property.com. So MURAT@𝗁𝗶𝘃property, which is MOORVIEW property, again, all one word, .com. Yeah, and that's it. Or like check me out on Instagram, Murat Jeffrey Haykir, or LinkedIn, or wherever you'll find me, hopefully.
Okay. And the videos you do, the vlogs, absolutely amazing. So
you like those ones? Thank you. Yeah, there's some funny ones on there as well, like when we went a couple of years ago when we went golfing with the board at the Belfry. There's some quite funny shots of that. So I tried to keep it light on there. Obviously it's serious, important stuff, the development side, but let's try and have a bit of fun with it as well. I've got a drone as well, so I try and do some drone stuff as well, drone videos.
Great. Thanks, Mo. Thanks for your time.
No worries. Thanks, Mark.
Yeah, great to go through that deal. Congratulations to you and the team.
Cheers. Thanks, Mark.
Cheers, Mo.